So dear students, as far as the leverage is concerned, what does the term leverage mean? How do we calculate it? How it is helpful? All those things that we are going to discuss. We are going to have a discussion like this. Listen carefully, that what do we understand with the term leverage? I request all of you to pay attention. Then we are going to have understanding that say how we are going to calculate a leverage. And the next thing that we are going to understand is how leverage will be helpful to the company or to the management. Because of course, whatever we are studying, it has say some application. So all these things that say we are going to understand over here. Basically friends, there are three types of leverage that we have. The first is given a name as degree of operating leverage. Next is given a name as degree of financial leverage. And the last is given a name as degree of combined leverage. So the first one is degree of operating leverage. You do not have to write anything. Let me explain you. The second is given a name as degree of financial leverage. And the last is called degree of combined leverage. Instead of giving explanation for all of them, first of all, initially I start with the term DOL, that is degree of operating leverage. I am giving some like the numerical values to give you explanation. Suppose recently financial year of a company has ended and sales of the company in the last year was, let us say, an amount of 80,000. Variable cost was, let us say, it was 30,000. Contribution was 50,000 and fixed cost was 25,000. Deducting contribution from fixed cost, operating income, earning before interest and taxes, is again 25,000. So the year which has just been completed, in that, so the operating income was 25,000. Now, let us say that there is a kind of meeting going on, and you are also part of the meeting, being finance manager of the organization. One of the director is asking a question to you. Suppose next year there is an increase in the revenue by 20%. There is an increase in the sales by 20%. So 80,000 plus 20%, that is 96,000. In that case, what will be the operating income? The question is that say what is the operating income? Can you write in the chat box that what would be the operating income in that case? I repeat my question. Recently year has been completed and sales of the company in the recent year was 80,000, variable cost 30,000, contribution 50,000, fixed cost 25,000, and operating income is also 25,000. It is expected that so the sales of the company is likely to increase by 20%. Okay, there is a board meeting going on, or a kind of, so the meeting is going on in the office, and in the conference room you represent yourself as a finance manager. One of the director is having a point to ask you that say, if at all there is an increase in the sales by 20 percentage, what would be the operating income? I want you to write in the chat box what would be your answer. So we understand that say sales increases by 20 percentage, 80,000 plus 20%. Variable cost will also increase in the same proportion, so it will increase to 36,000. So 96,000 minus 36,000, contribution will increase to 60,000. There will not be any change in the fixed cost. The fixed cost was earlier 25,000. Even right now it is going to remain same 25,000. Importantly, the fixed cost does not change, so it is called fixed cost. So the operating income is 35,000. This is the way we can have a simple calculation of the operating income. It is 35,000 rupees. At the same time, okay, the meeting is yet going on. One director say is asking a question to you that say, instead of increase in the sales, suppose there is a drop in the sales by 10 percentage. Then in that case, what would be the operating income? That is a question. What would be your answer? It is 80,000 minus 10 percentage. So he says that say, suppose next year sales reduces to 72,000. In that case, what would be your answer? With the reduction in the sales, variable cost will also reduce. So 72 minus 27, contribution will reduce to 45,000. No change in the fixed cost. Again, it is going to remain same. And the profit will be 20,000. This is the way we will be having the profit in the different situations. Listen carefully what I am going to speak further. One more question is there by everyone. That say, what is the percentage change in operating income? With the change in the revenue, what is the percentage change in operating income? Then in the first case, it is 35,000 from 25,000. So there is an increase by 10,000 upon 25,000 into 100. So 10 upon 25 into 100, that comes to 40 percentage. In the second case, it reduces to 20,000 from 25,000 divided by 25,000 into 100. So it reduces by 20 percentage. So what will happen? Based on whatever the calculations that we have made, we can understand that say, if at all the sales of the company increases by 20 percentage, profit of the company, that is operating income, increases by 40 percentage, and sales reduces by 20 percentage, then operating income will fall down by 20 percentage. This is what we understand. So all this discussion are going on. One more director says asking that so the sales is changing by this much percentage, this much, and all these things. In this, like the discussion, there was a question by one of the director, technical director. He had a question like this. He says that say, I'm unable to understand. This is the change in the revenue, and this is the change in the operating income. Why both of them do not match? If the sales increases by 20%, then logically, according to me, operating income should also increase by 20%. When the sales is falling by 10%, this should also fall by 10%. However, I am unable to understand that say why these two figures are not matching. That is the kind of query that say he is raising. So I request you to tell me in the chat box, let's say, how will you answer said to that director, let's say why these two values do not match. We understand that so over here it happens like this because of the total fixed cost. We understand that as far as the total fixed cost is concerned, it is going to remain same. That is the reason what happens at say when there is an increase in the revenue, operating income increases, however it increases at a higher rate. And when there is a reduction in the revenue, operating income reduces, however it reduces at a higher rate. Because with the increase in the sales, fixed cost does not increase. So you are able to increase the operating income at a higher rate. And when there is a reduction in the sales, fixed cost does not reduce. That is the reason, so the operating income reduces at a higher rate. That is what we understand. So basically over here we understand that so the percentage change in the operating income does not match with the percentage change in the sales, because we understand that say the amount of the total fixed cost is going to remain same. That is the reason. Now understand carefully, whatever this point is reflected in calculation of the DOL. I request all of you to pay attention. Dear students, DOL, degree of operating leverage, is measuring what is the percentage change in EBIT for every 1% change in sales. What does DOL measure? DOL measures what is the percentage change in EBIT for every 1% change in sales. How DOL is calculated? Dear students, DOL is calculated as contribution upon operating income. What is the contribution? Contribution is 50,000. And what is the operating income? It is 25,000. So it is 50,000 divided by 25,000. So degree of operating leverage is 2. How do we understand the DOL value 2? We understand that so the DOL value 2 means for every 1% change in the sales, operating income will change at the rate of 2%. Over here, sales increases by 20%. So 20% into 2, operating income will increase by 40%. Sales is reducing by 10%. So 10% into 2, it reduces by 20%. That is the way, so we understand that so the degree of operating leverage is measuring, what is the percentage change in EBIT for every 1% change in sales. Why do we calculate is yet to be explained. Why do we calculate is yet to be explained. What we are calculating and what kind of relationship it measures is the only point that I am discussing. Then gradually I will be explaining that portion also. So right now we understand that so the DOL is calculated using a formula as contribution upon EBIT, and whatever the answer of the DOL, it is measuring that what would be the percentage change in the operating income for every 1% change in sales. Giving explanation of the derivation of the formula. Everybody is requested to pay attention. See, right now I am focusing on a point like this, that how DOL is calculated. This is the way it is calculated. I am explaining the derivation of the formula, whatever the answer of the DOL, what does it show? It shows that what will be the percentage change in EBIT upon percentage change in sales. Sir, why do we calculate the DOL? I'll explain that say in some moments. So whether the DOL should be more or less, wait, I'll explain that point also to you. For the time being, focusing on the derivation and gradually we will be proceeding further. Okay. Dear students, we can say something like this. Understand carefully. We can say that the change in EBIT is equal to change in contribution. See, try to understand it like this. EBIT changes from 25 to 35. What is the change? 10,000. It is equal to change in the contribution from 50,000 to 60,000. So change in EBIT is equal to change in contribution. Okay. Now we can say that say change in EBIT is equal to change in sales minus change in variable cost. Because what is the change in contribution? Change in contribution is equal to change in sales, that is 16,000, minus say the change in variable cost 6,000. So 16 minus 6, it comes to 10. Okay. Next, change in EBIT is equal to change in sales minus, listen carefully, change in sales into variable cost upon sales. Dear students, variable cost upon sales is indicating variable cost to sales ratio. See, right now the variable cost is 30,000 and sales is 30, that is 80,000. So 3 upon 8, that comes to 37.5%. Sales increases by 16,000. So 16,000 into 0.375, that comes to exactly 6,000. So what is the amount by which the variable cost is changing? Variable cost is changing with an amount equal to change in sales into variable cost upon sales, and variable cost upon sales is indicating variable cost to sales ratio. Now it's very simple. See, change in EBIT is equal to, now this is the change in the sales and this is also change in sales. So I take that common. So change in sales into 1 minus, okay, minus sign is from here, variable cost upon sales okay, 1 is taken common, that 1 in the bracket is representing change in the sales. So rewriting the equation, change in EBIT is equal to change in sales into, see, this 1 is nothing else but it is like 1 upon 1. This 1 is nothing but it is 1 upon 1. So now what we will do, we will take LCM of sales and 1. What is the LCM between both of them? Sales is the LCM. So divided by sales. And the numerator will be sales minus variable cost. Okay. Now on the both side, what I am doing, friends, I am dividing simultaneously with EBIT. because for the purpose of derivation you can do anything on both the sides. So I'm dividing both the sides with EBIT. Change in EBIT upon EBIT is nothing else but it is percentage change in EBIT. Now you can see that it is change in sales upon sales is what? Percentage change in sales. Sales minus variable cost is what? Contribution upon EBIT. Now we are on the urge of completion. So contribution upon EBIT is equal to, this is kept as it is, percentage change in EBIT upon percentage change in sales. And this is what we understand is what the DOL measures. This is given a name as DOL, degree of operating leverage, which is found as contribution upon EBIT, and it measures what is the percentage change in EBIT for every 1% change in sales. Let us see a question. ABC Limited is considering manufacturing and selling of a product. The company is considering, highlight the portion, either to implement plan A or to implement plan B. So we are considering to implement one of the two plans. Following information have been given about expected results of each of the plan for year 1. So for the very first year, information is given to us. We are considering either to implement plan 1 or plan 2. So plan A or plan B. Sales is given, variable cost is given, contribution is given, fixed cost is given, operating income is given. From above information, calculate EBIT. EBIT stands for operating income. For second year, first year information is given for second year. For each of the plan, means if you would have selected plan A and if at all you would have selected plan B. If the sales increases by 20%, second question, if the sales decreases by 10%, third question, which plan the company should select in the first year. That is the way the question is there. So first of all, we can make the calculation of the operating income for the second year in case of the sales increases, in case of the sales decreases, and after that, so we will discuss the third part of the question. We'll do some values, we'll do some calculations, and then I'll dictate a detailed note to you. Let us answer the question. Calculation of EBIT of year 2, comma, for each plan, comma, if sales increase by 20%, comma, sales reduce by 10%. So in both the cases, we are required to make the calculation. So sales, in the first case, it increases by 20%. In the second case, it reduces by 10%. Plan A, plan B, plan A, plan B. That is the way, so we are required to prepare the table. So friends, over here, we understand that say we are required to answer, that is calculate the answer in this way. I request all of you to write an answer along with me. In the first part of the question, it says that so the sales increases. Sales. In case of plan A, I am writing first of all, it is 1 lakh plus 20 percentage. That comes to 1,20,000. Variable cost. From 80,000, it will increase by 20 percentage. That comes to 96,000. Contribution is difference between both of them, that is 24,000. Fixed cost is not going to change, that is 10,000. So earning before interest and taxes is 14,000. Along with that, I am doing one more thing, percentage change in EBIT. What happens at the EBIT increases to 14,000. The EBIT was 10,000. So it increases by 4,000. So 4 upon 10 into 100, it increases by 4040 percentage. That is the way I have made the calculation. One more thing. Please write down answer along with me. In case of B plan, what will happen? Sales value same. Variable cost will also increase 60,000 plus 20 percentage. That comes to 72,000. So contribution is 48,000. In fixed cost, there is no change. It will remain 30,000 as it was before. Then it is 18,000. Percentage change in EBIT will be 80 percentage. How 80 percentage? It is 18,000 minus 10,000 divided by 10,000 into 100. So it increases by 80 percentage. Okay. Now if at all there is fall in the sales by 10 percentage, what will happen? In that case, we understand it is 1 lakh minus 10 percentage. That comes to 90,000. Then it is 80,000 minus 10 percentage. That comes to 72,000. So contribution will be difference of both of them. That is 18,000. No change in the fixed cost. It is 10,000. Operating income will be 8,000. So from 10, it reduces to 8. So it reduces by 2,000 and it reduces by 20 percentage. So that can be calculated like this. 8,000 minus 10,000 divided by 10,000 into 100. So it reduces by 20 percentage. The last one. Again, the sales will reduce to 90,000. Variable cost will be 60,000 minus 10 percentage. That comes to 54,000. So it is 36,000. Fixed cost no change. EBIT will be 6,000. As far as the percentage change in EBIT is concerned, it is 6 minus 10 divided by 10 into 100. So there is a reduction in the operating income by 40%. So these are the values that say we are able to calculate as a part of the answer. Now I want you to write in the chat box which plan the company should select in the first year. Company should select plan A or plan B. Give your answer along with the reason. Here is the first year result. Here is the first year result. And here is the subsequent year result. If at all the sales increases and if at all the sales is falling down. Based on that, I want you to give me answer for the third question. Let us have a detailed understanding of the third part of the question. And this is also the concept that we are going to discuss. Of course, I'm not giving explanation to you entirely for all the leverages. However, at least for DOL, I'm trying to give an explanation to you. See, looking to the results of the first year, what we can observe that say the operating income of year 1 for both the financial plans are same. Is it like that? Yes. Operating income for both the financial plans are same for the first year. So basically looking to the first year result, I feel that I'm indifferent whether I go for the A plan or I go for the B plan. Is it the way I'm supposed to answer? Or let me see further. What I can see that say if at all the sales increases, then in that case the operating income will increase for both the financial plans. However, it increases at a higher rate in case of the B financial plan. And if at all there is a reduction in the sales, then in that case for both the financial plans, so there will be reduction in the operating income. However, it will be less in case of plan A. So we can say something like this. Listen me carefully. We can give, that is we can make the calculation of the DOL. Listen me carefully. It is contribution upon EBIT. Taking into account the first year details of plan A and plan B. For plan A, it is 20,000 upon 10,000. So the answer is 2. And for plan B, it is 40,000 upon 10,000. So the answer is 4. So what happens, let's say, leverage of plan A is 2 and leverage for plan B is 4. We can tell to the management like this. Listen me carefully what I am going to speak. We can tell to the management that say, what is your future expectation? If at all you are up, you are expecting that say there will be growth in the sales, then in that case you should select a plan which is having more leverage. A plan which is having more leverage will have more chances of the increase in the profit. If at all your sales increases and you have selected a plan which is having the less leverage, will also have increase in the profit, but the rate at which the profit increases will be less. You can see that say in a situation where the sales is improving, for plan A, increase in the operating income is at a lower rate in comparison to B. And if at all you are not sure, or maybe you are having a fear that the sales of the company will fall down, you should be having say the lower leverage. Why? Because what will happen if at all say the sales of the company reduces, then for both the financial plans, both the operating plans, the operating profit is going to definitely fall down. However, in case of a plan which is having lower leverage, the reduction in the operating income will be at a lower rate. You can see that say when the sales is falling down, for both the financial plan, say the EBIT reduces. But in case of the A plan, it reduces by only 20%, and for B plan, it reduces by 40%. So we can generate a report to the management that say DOL of both the financial plans are different, and say the DOL is measuring Listen carefully. DOL is measuring what is the risk that the company has. What is the effect of the fixed cost that say we have that is introduced in the business. If at all you are having the comparatively more fixed cost, then in that case the leverage will be more. For plan B, you can see that the fixed cost is 30,000, which is more than 10,000. It means that the risk in case of the plan B is more. So if at all you are expecting the sales to go up, go for plan B. If at all you are not sure or you are expecting the sales to fall down, you should go for plan A. That is the way we are supposed to give answer for the third question. Friends, I am giving explanation to you something like this. Listen carefully. How are we going to calculate leverage? That I have explained to you along with the derivation of the formula right now only for DOL. How do we understand the term leverage? Leverage is understood as it is a tool which measures the effect of the fixed cost that we have introduced in the business. Leverage is understood to be a tool which is useful to measure the effect of the fixed cost in the business. Higher the fixed cost, you will be having more leverage, and lower, and vice versa. Degree of operating leverage. The term operating stands for whatever the operation of the business that say we are doing. For that, so the effect is measured by DOL. And third, listen carefully, how leverage will be helpful to the company. Leverage will be helpful to the company to decide that whether the company should be having more fixed costs in the business or less fixed costs in the business. If you are up, if at all you are optimistic for increasing the sales, you should be having more leverage, otherwise you should be having less leverage. Answer for the third part of the question, write down. Answer for the third part of the question, write down. Decision making about selection of plan in the year 1. Full stop. In that, write down. We can observe that both plants have same sales, comma, same EBIT, and same total cost in year 1. So apparently the company is indifferent whether to select plan A or plan B. Full stop. However, component of total cost of both the plants are different. Full stop. total variable cost, total fixed cost, total cost. Plan A, plan B, 80,000, 10,000, 90,000, 60,000, 30,000, and 90,000. With paragraph write down, so we can compute DOL, degree of operating leverage to draw conclusion. Full stop. Please write down answer for DOL with paragraph write down. We can observe that plan B has higher leverage. Full stop. We can advise the company, comma, read on 1, to select plan B, comma, if there is an expectation of increase in sales. Second, to select plan A if the company is uncertain or expecting fall in the business, or expecting fall in the business. Full stop. Third point, sorry, with paragraph write down, we can say that leverage is measurement of risk in business. Full stop. DOL measures effect of operational fixed cost. Full stop. Higher DOL will have an advantage of increasing EBIT at a higher rate with increase in sales. lower DOL will have an advantage of reducing EBIT at a lower rate if sales is falling down. Full stop. Further down, DOL measures percentage change in EBIT for every 1% change in sales. See friends, over here for plan A we have computed DOL as 2, and for plan B DOL is computed as 4. So what will happen, listen carefully, focus on A plan. 20 into 2, this is 40%. Negative 10 into 2, negative 20%. 20 into 4, positive 80. Negative 10 into 4, negative 40. This is the way the percentage change in EBIT can be calculated for every 1% change in sales. Everybody is requested to go through the entire note that I have dictated to you for the third part of the question. So ultimately, after this, like the huge discussion, we understand that say we will tell the company that say depends upon your future expectation that whether you should select the plan A or plan B. We can give this presentation to the management that going with the higher fixed cost will have advantage if at all the things are positive, but at the same time you be prepared if at all the things are not as per your expectation and the sales is falling down, then sharply the operating income is going to fall down. And suppose you are not confident, then in that case you should go for the financial, that is a plan which is having say the lower fixed cost, lower leverage. In that case you will make progress at a lower rate, but of course that will make sure that say you will not be having any moderation if at all the sales is falling down.